Welcome back to The Mind of Money with Douglas Lodmell and my guest, Neal Rubin. Neal, you were just going to tell me what we did differently in our situation today than what Japan did with their lost decade, because a lot of it is the same. I mean, they did the quantitative easing. They've had zero interest rates for 10 years.
Right. Well, they've had really low interest rates, but initially they didn't do the quantitative easing. They did a lot of fiscal stimulus, but they actually constricted the money supply. They raised taxes. I mean, they did things that were really very negative for the economy. This Fed and the federal government has been much more aggressive.
Well, there's no doubt about that.
Yeah, and rightly so. And people are concerned about quantitative easing, the printing of money, and on a per se basis, it's not bad. It becomes a matter of magnitude. And clearly, the first round of quantitative easing that the Fed did, I think pretty much everybody would agree, was necessary and worked. The second round is obviously under a lot of debate right now. From our perspective, it's sort of a tempest in a teapot, in that the amount of money that they're talking about printing isn't significant. And if you go back to
it's not significant necessarily to have an impact either. I mean, the one thing Bernanke said was,
correct.
This round is going to lower interest rates. Well, it didn't increase.
Well, one of the things you have to realize about the economy is it's extremely complex, and there are a lot of things that happen that might not necessarily make sense at first blush. One of the things that people...
Do you think that, I'm sorry to go on this point, but do you think, you said it's extremely complex.
Right.
Do you think that the Fed has really a handle on how complex it is and are pulling all the right levers?
I think anytime you get people involved, there's room for error. They have a tremendous amount of resources. They get a tremendous amount of data. They're very, very smart guys. Can they get it wrong? Absolutely.
Have they gotten it wrong in the past?
Absolutely. but they've also done some things that are right.
Yeah.
And a lot of people give Bernanke a lot of credit for, saving the economy. And in fact, there was an op-ed piece in the New York Times, I think yesterday, by Warren Buffett, basically saying, the government did everything right in 2008.
Yeah. Warren is saying he's on the record with that.
No, I mean, people can disagree. There's a guy that manages a lot of money, and he doesn't have to be invested. And I don't think anybody's necessarily paying him to write that.
Yeah.
But they can clearly get things wrong. But when people look at this latest round and they say, well, rates have gone up, it really hasn't worked. One of the things that people could say is that
it hasn't done what he said it was going to do. That's the thing that's interesting to me.
Right. Well, there are a couple things. First of all, I think rates moved in anticipation of it to begin with. And a lot of times when you deal in the markets, you have to realize that the markets sort of try to see in the future, and so they will do things in anticipation of something happening. Once it's actually announced, that's sometimes too late. Number two, they haven't started buying anything yet.
Oh, they did. They bought $8.5 billion this week.
But I mean, very, very small numbers.
Yeah.
Very, very small numbers. So, and when rates really started going up was early on or later last week, and people were saying, well, rates are going up. They hadn't bought anything at that point in time.
Okay.
And there are a lot of other things that move the market. So,
tough
to say right now.
So the difference really with Japan, but back to this concept of this lender of last resort, I mean, this time it is different in the sense that we have hit the final wall.
Correct.
And so, but the outcome, there's a fairly strong voice out there that says, this time it's different and we're going for global collapse because there is nobody to bail out the U.S. government.
Right.
And the other perspective is that this time it's different, we're going to have to get our act straight.
Right. This time is different. This time is different. There's not going to be a global collapse unless somebody does something not smart, which is always possible.
Yeah.
Something can always happen you can't foresee. This time is different is that you're in for a 10-year period of very slow growth.
Okay.
And in the U.S., 2% growth, 2.5% growth is not enough to reduce unemployment. It's not enough to reduce the output gap. It's not enough to really get any sort of significant inflation, which is why you see Bernanke doing what he's doing. And for people that don't have a job or aren't getting big pay raises, it'll feel like a recession. I mean, that's why people are saying...
I can tell you it feels like a recession right now.
And for a lot of people, and if you live in Florida, if you live in Las Vegas, or if you live in Arizona, if you live in California, where real estate has really taken a hit, it still feels a lot like a recession. If you've lost your house, it feels like a recession.
It feels like a recession, and the funny thing is the CPI is going down.
Right.
But by that, the consumer price index, but it's going down based on these big inflationary assets like real estate.
Right.
But it's going up in the stuff that we buy in the stores. I mean, gas is more expensive.
Right.
Food is more expensive. Insurance is more expensive. I mean, everything that we live on. So the effects are really, it's really a double whammy on us.
Right. That's very true, but that does not necessarily mean, people tend to draw a straight line ad infinitum.
Yep.
So when the stock market was going down and it hit 6,800 on the Dow, well, it was going to zero.
Right.
Well, the fact that milk's going up, the fact that beef's going up, the fact that gasoline's going up doesn't mean that that'll continue forever. Those numbers are also off of relatively low numbers that they're comparing them to, and those kinds of commodities tend to sow the seeds of their own destruction in them. I mean, it wasn't so long ago that oil was at $130 a barrel, and where was everybody saying it was going? It's going to 200, 250, it's America's energy crisis. Where did it go? It went to 30. So again, there's a lot to look at there, and one thing doesn't necessarily lead to another. And these big factors, I mean, again, if the U.S. consumer is 70% of the economy, and there's 10% unemployment, and they're deleveraging, all those things are true, they're not going to have a lot of money to go around and chase all these goods. The biggest driver of inflation isn't milk, it's not gas, it's wages. And again, if there's 10% unemployment, you're not going to have wage growth. We're also competing in this world where everybody is at a lower wage than we are. So again, there are these things that I'm not saying it's going to be this great picture or you're going to be growing at 6 or 7%, but 2% growth is growth. That's not to ignore the fact that people are hurting.
It's not global depression in your eyes.
Right. That is not our call right now. Now, when we make a call, we're making a 6-month call, a 12-month call.
Right.
It's not that
you reserve the right to say we could be in a global depression.
Well, we can't see out 10 years. I mean, we can't see out 5 years. It's tough to see out next month. It's tough to make a 12-month call. Okay. But given everything that we know, we don't see this huge debacle within the next year.
Right. Good. Let me give you a case, because this is a very common profile client of mine. I had this call actually 2 days ago, so it's very fresh in my mind. This client has paid for real estate, a couple $1 million, and so for him, he's not stressed at all.
Right.
And the entire balance of his portfolio is the liquid part. Another $3 million is invested 100% in municipal bonds.
Right.
What would you tell him today?
Well, again, we'd really want to understand his risk-return profile, which I don't know.
Well, he's obviously very conservative.
Well, I mean, you could say that, except he's very concentrated, which is a sign of somebody that's more of a risk taker.
So I really would have to unaware of the fact of how much risk he's
and
really
there may
taking.
be that, but if you think about it, you can easily say, well, he's in muni bonds and that's risky. But I'd expand it even further because, first of all, he's very concentrated in the United States. U.S. real estate, 100%. U.S. muni bonds. Number two, to my mind, real estate is exactly the same asset class as fixed income.
Right.
How does fixed income get hurt? Fixed income gets hurt
increasing interest rates.
If interest rates go up, the price goes down. Same thing on the real estate side. So he's really making a concentrated bet that interest rates are going to stay low for an extended period of time.
Right.
He's also making a bet that munis, and not knowing the munis he's in, that the munis he's in are not going to have problems a la California,
he
a la
happens
Illinois.
to be in California.
Okay. So,
and he bought all California munis to have the double tax benefit.
Right. So he made a great call whenever he bought them.
Yeah.
It's been tremendous. It's been a tremendous bond market rally.
Yeah.
Interest rates at some point in time have to go up.
Yeah.
Now, the secret is knowing when that is. That's impossible to call.
Yeah.
They could stay long for an extended period of time. But even having said that, California clearly has problems.
Yeah.
And there are alternatives. There are other things you can do, and that's what we talk to clients about. There's fixed income outside the United States that can be purchased. People may look at that as being more risky, but from a risk-return basis, we don't necessarily think so.
So for this guy, from my perspective, he's really taking a lot of risk in that interest rates can only go up. I mean, they're at zero, so that means his portfolio is going to go down. He's also taking a risk in the sense that there is a risk of default that is not currently really priced into those bonds. Certainly was not priced in when he bought them. And now I think it's very real that we have to consider that U.S. municipals have a risk of default.
Yeah, U.S. municipals are not all created equal. Clearly, California municipals have a serious risk of default. He's very concentrated there.
Yeah.
Again, somebody like that, non-U.S. fixed income, things like trade finance are very interesting, we think. High dividend stocks. People consider the stock market to be risky. If you look at a risk return analysis of California munis versus a diversified portfolio of high dividend stocks that are yielding 6 to 6.5% and have the possibility for upside in a market that we see as being fairly valued, if not slightly maybe undervalued.
Right.
To do some diversification into that would be absolutely the right thing to do.
Well, and he has really, at this moment, no risk to liquidate his bond portfolio. It's up. He's ridden the rally. I mean, he's gotten a huge rally. Everything has been great. Why push it? And my advice would be just why? What is the big upside for you holding?
Correct. And his return going forward, even if nothing happens, his return going forward is going to be de minimis because the bonds that are maturing are going to mature at par. Right. And so he's going to be losing capital on his investment. He could make a change now, which he should do regardless. But even if there wasn't that risk, we'd probably say, look, you've gotten about all you're going to get out of those bonds. Why not make a change now?
You've ridden the ride, yeah.
You've ridden the rally. I mean, it's, selling the Dow at 14,000 or the S&P at 1,400.
Yeah.
It's really the same thing. And there's some things to do that are not obvious in terms of being safer, but just diversifying into them make them safer, whether they're these foreign fixed income opportunities or some alternative.
I mean, if you don't know what to do, if you absolutely are confused, go sit in treasuries for 12 months.
There's nothing wrong with being in short-term treasuries.
Yeah, so, okay, when we come back, we're going to wrap up with, I'd like your outlooks on what's happening and some final thoughts for our viewers. So,
great.
Thanks for joining us on The Mind of Money. We'll be right back.